Hello, and welcome back to Intro to Options with DAS. This is a Level 3 Credit and Debit Spreads focused course. Again, all of our options classes are at the levels that your broker is required to approve you for options trading. So if you're approved for Level 1 options, that means you can trade covered calls and protective puts. Level 2 is buying calls and puts. And of course, Level 3, where we're at right now, is credit and debit spreads. If you don't know what that is, you'll learn that by the end of today, and by the end of this session. And then of course, next is naked writing or uncovered writing of options, which is a pretty advanced strategy and certainly not suitable to everybody. And that brings me to our disclaimer. This would not be a financial seminar if we did not have a disclaimer. All of the representations made are for educational purposes only, and it's for training to teach you the risks and the possibilities of trading options. Trading and investing is not suitable to everybody, and certainly you should get an education first. On that note, I am available for mentoring, and I can work with you to learn options on an individual basis and learn how to use your DAS trading platform, as well as technical analysis and trading in general. Just a little bit about me. I've been trading for many, many years. Started trading in 1998 and 1999. I did invest before that, but professionally trading since 98, 99. I've been in pretty much every role on a trading desk that you can imagine: trader, risk manager, market maker, trading desk manager. I've traded stocks, options, futures, Forex, and FX, and even cryptocurrencies. But obviously, I'm here from New York, and New York is an options and equities town. So that's kind of where I cut my teeth. I am a licensed licensed financial professional. I have my Series 7, 63, 55, and 24 securities licenses. And I work here at DAS as an educator, producing content, as well as doing institutional sales. But enough about me. Let's get on to the options trading series. We've already covered a lot. If you haven't already joined us for our Level 1 course, which is a great class, Level 1 is about covered calls and protective puts. Level 2, another great class about swing trading options using long calls and long puts. And then, of course, where we're at right now, the Intro to Options, Level 3, credit and debit spreads. Personally, this is my favorite option strategy. One of my favorite income producing strategies. I'll get into that a little bit, but certainly if you want to learn more about that, you can schedule a session with me individually, and I'd love to tell you more about it. And then finally, just for even measure, not my favorite strategy, although certainly worth learning about, uncovered or naked writing, which is a little speculative, also has some risk elements that you should be well aware of. A lot of people love it, but certainly we'll cover that when we get to it. Let's jump right in, and let's talk about which strike price and expiry. And this is more just kind of options basic. So the options quote screen, this is your options quote screen. It's also called an options chain. The stock ticker for the underlying. So in this case, the underlying is the SPY, the spiders, which represent the S&P 100 ETF. The expiry, and you can see all the tabs right up here on the top. You can see the different expiry weeks as well as expiry months, because some options are weekly options and some options are monthly options. And then we got our strike prices right here in the middle. Now we mentioned you can buy calls and you can buy puts. You can write calls and you can write puts. So our calls are right here. Our puts are right here. So on this side is our calls. On that side is our puts. You can also kind of exclude that so you don't make any mistakes. You can have just a window that has calls, just a window that has puts. And then here we have our exchange view and our order entry screen. Okay, here's our OES. So here we go. We're moving right along. Options quote screen, talking about the inside market. So it's a little bit different than what you're used to in Level 2. Some things are the same, some things are a little bit different. So let's just go through the similarities and the differences. So last indicates the price that the last option trade was made, which is very meaningless in thinly traded options. Okay, so you could have a last that, I mean, some options trade by appointment, we used to say, in the professional trading world. So some options don't have a tremendous amount of liquidity. As you can see, as we go down here, look at the volume is 0, 0, 0, 0, 0, 0, 0, 0, 0. But you can see here we have a little patch of activity. But you can see on all day it only traded 101 contracts. Here it traded 0. This traded 100. This traded 202. So some options, if they're not close to the current price, may have no activity, and some options may have a lot of activity, even if they're away from the market, as these are. So last sometimes is meaningful and sometimes meaningless. The bid and the ask have the same definition as in the equities market. The bid is the price in which you would receive if you're selling the call. The ask is the price that you would receive or pay when you're buying the call. So that's the bid and the ask. And here we can kind of see our best bid and ask on this particular contract. It's 175.18. This is actually 175.18 by 175.86. That obviously is very far in the money. But needless to say, you get the gist. That's the inside bid and the inside ask on the exchange view. Okay, moving right along. Options table strike prices. So notice that the strikes move in $5 increments, right? Because this is kind of far away from the inside market. Currently, the S&P is trading at 364 on this particular example. And, we're looking at the 165 to the 265s, right? So we're kind of far away from the market, and they're moving at $5 increments. And that also goes, some options are going to trade by $1 increments, $2.50 increments, then $5 increments, etc., depending on the price of the underlying. The call strike price is at a price which the owner of the call option has the right to buy the stock if the option is exercised. The put strike price is the price in which the owner of the put option has the right to sell the stock if the option was exercised. So just a little review on what a call and a put and what strike prices mean in relation to calls and puts. All right, so let's just explain. So we've talked last time in the level 2 class, we talked a little bit about option terminology. We talked about in the money, out of the money, and at the money. Today we're going to talk about time value, okay? And time value is exactly one of the variables that makes options a little bit more difficult than trading stocks. So there's the cost of time. Okay, so let's just cover some definitions. Premium. The premium is the price paid when buying an option, okay? And the option is the price of the option is composed of both intrinsic value and time value. And I want you also to notice these kind of abbreviations: intrinsic value, which is a capital I-N-T, capital V. And then, of course, we got time value, which is just TV, time value. Buyers of options normally pay the ask price when purchasing. The premium is quoted per share. Therefore, the total amount of the premium is normally 100 times the ask price. One contract equals 100 shares. Intrinsic value is the amount of money that can be realized if the option is exercised. So that's the difference between the current price and how deep it is in the money, right? We were talking about last time in the money option. So the intrinsic value is the price of the current underlying, and the difference between the price of the current underlying and the strike price. So if it's in the money, it would be deep. It could be deep in the money. It could be slightly in the money, but it's the amount that it's in the money. Okay. Time value is the difference between the option premium and its intrinsic value. So if you're buying right now it's in November and we're buying a call in January, you're paying a lot of time value. Okay. If it's out of the money, you're only paying for time value. If it's in the money, you're going to pay for intrinsic value plus the time value. Okay. So time value is the difference between the option premium and its intrinsic value. It is the amount of money that the buyers are willing to pay in anticipation of the stock moving in the desired direction of the option. Up for calls, down for puts. Time value is influenced by the amount of time to the expiration and the volatility of the stock itself. And I want to go into this a little bit more because time value rapidly decays as you get closer to expiration. So if you're trading and selling calls, weekly calls, that last week is going to be where the majority of the time decay occurs. The last month in a monthly option is where the majority of the time value is going to decay. Time decay is going to occur in the last month before the expiration. So always be aware, time decay increases rapidly as you get closer to expiration. All right, so let's talk a little bit more about in the money, at the money, and out of the money. Okay, and this is on our option quotation screen. Okay, so here we have the S&P, right, which is currently trading at 364 in this example, and you can see 364 is right here. So you can see how the volume increases right there at the money, okay, and a little bit out of the money is where it's the most active. So in the money strike prices for calls, in the money strike prices have both intrinsic value and time value in their prices, okay. At the money options they don't have intrinsic value, they're all time value, but they fluctuate in and out of a little bit of intrinsic value. Out of the money options only have time value in their prices. Okay, so it's again, in the money options have intrinsic value plus time value. At the money is just fluctuations and it has time value. Out of the money is just time value. All right. And of course, we can see that the activity, it goes on both sides, right? So as you go down from your at the money option, the put activity increases as you go down. That's going in the money. So as you go deeper in the money, you can see the volume increases. And the same goes a little bit initially. The volume increases as you go a little bit out of the money for calls. And of course, it decreases as you get a little bit deeper in the money. And that's because people are speculating to the long side. That's telling you something about what people's opinions are. If there's lots of options activity in the money on the put side, that's because they're nervous. They're buying protective puts because they're worried about something. And if there's more activity on the call side out of the money, maybe there's a lot of people who are bullish. We're going to take a look at the next chart, which is the intrinsic value review matrix. And here we have it, the value of the underlying versus the derivative. And of course, the underlying is the stock and the derivative is the option. But a derivative can be anything that's derived from something else's price. So here we have $50, okay, which is at the money, okay? And then we're going 49 is in the money, and we're getting deeper in the money as we go down by each dollar. Right? So the intrinsic value is $1 at 49. If it's 50 is at the money. So we go down to $5. $5 in the money puts us at 45. If we go out of the money, you can see here that you got out of the money, you got zero intrinsic value. Okay. Here you have no intrinsic value on the put side. So you're out of the money on the put side and you're in the money on the call side, okay? And you can see how it works. It's kind of a matrix where you're in the money and you got some intrinsic value here on the puts as you go higher, right? Because the put at the money is at 50. So if you're $5 in the money on the puts would have to go up $5 to lose all of their intrinsic value. You kind of get the gist of how it works. So let's continue right along. And we talk about the available strike prices. Okay, the strike is the price in which the stock can be bought, okay, on a call or sold on a put. Okay, stocks that are less than $5 are optionable. Okay, some of them are. They're not always optionable, but they don't have to be optional. And usually the ones that are optional are ones that were recently above $5 and then dropped below $5. Okay, stocks between $5 and $25, the strikes are set at $2.50 apart. Stocks above $25 are set $5 apart. Above $200, they're set $10 apart. The QQQ has lots of dollar options, and they have a lot of other variations, some very, very heavily traded options like the QQQ, the SPY, and the DIA have additional expirations as well as some additional strikes. So the strike price you choose depends on your expectation on the stock before expiry. Not all stocks are optionable, so certainly some penny stocks are not, stocks that are pink sheets or penny stocks may not have options. Some that are pink sheets do have options, so you just got to check the options market and certainly check with your broker. Strikes are impacted with splits. They're generally factored in. Dividends also come out of the option price, so always be aware if there's going to be a dividend paid. Be aware of that as well. That's factored into the price of the option. Okay, expiry. How much time do I need? Okay, so realize if you're buying time, it costs money. So time is the only constant in options pricing. Time is the only constant. It moves at a steady pace. Options are a fixed time instrument, so they're only good for a period of time. How much time do you need to let the stock perform? This is time premium, right? So this is a time premium. How much premium is the time value worth? Okay, time erosion is calculable. So TV equals time value. Okay, time value equals everything else, including intrinsic value. So the options buyer wants time. In my opinion, I like to buy more time if I'm expecting a move. Things in my life, as well as in my trading, seem to never happen when I want them to happen. So I usually am willing to pay for more time. Option sellers sell time. They want things to, they generally want to sell close to the current time frame, right? Because that's when the time decay is the fastest. So as an options buyer, I usually want to buy with more time. And if I'm selling, I want to sell where the time is going to erode the fastest, and that's usually close to expiration. So you should take swing trading options with at least 2 weeks to expiry. That's my own personal rule. Is let's say I want to swing trade ABC company. An ABC company is currently trading at $20. So I'm going to buy. I usually buy a little bit in the money. So let's say it's currently at $20. I'd buy 19. And I would buy the first week of December if it's currently in the second week of November. So I'd go into the early part of December. Now, I will trade it away after 1 week if it's not doing what I expect it to do. But I don't want to have to pay for the time value. I'd rather trade it away while I still have lots of time left. And even if I want to keep it, I would roll it to the next week. And that's called rolling your options forward. So we favor option selling close to expiration. So as I said earlier, I like to buy time. If I'm buying calls or if I'm buying puts, I buy time. And then, of course, I sell close to the expiration because that's when time value is the greatest. Okay, spreads and straddles. Okay, buy and sell the same type. Okay, so spreads and straddles, those two different strategies. Personally, I've done more spreads in my trading than I've done straddles, and I will tell you when a straddle is effective. But for the most part, I'm going to be spending more time on bull spreads and bear spreads, and I'm going to talk a little bit about diagonals, and those are called calendar spreads, and those for me make the most sense, and I'll explain why. So you buy and sell the same type, okay, put or call of an option on the same stock, but with different expiry months or different expiry weeks, okay, exercise prices or both, okay. A bull spread is purchasing a lower strike price than the one sold. So you buy 20, you sell 22. That's a bull spread, okay. A bear spread is you purchase the higher strike than the one you sold. Okay, so you're buying 22 and you're selling 20. Okay? So the title of the spread tells you whether you're a bull or a bear. Okay? And whether or not there are calls or puts included in the spread. Okay? This is done to reduce the risk of loss involved in a single option. Okay? And it also reduces the cost of participating in a single option. So you're collecting money, okay? And then you're using some of the money you collected to buy your insurance or vice versa. Not done to make a profit on the second leg. It's really just to reduce your cost and to reduce your risk. Legging into any spread can be more profitable because by legging in, you're timing your entries and you're trying to get a better price by using market timing. A vertical spread, a price spread, the strike prices are different, but sometimes the expiry are the same. That's a vertical. Okay, a diagonal is when the expiries are different. Okay, stop out on both. Okay, or at a losing position if the stock is not doing what is expected. So if you still use your stop and risk management rules, just like you do in any trade, risk and margin requirements are less when you're doing spreads. So let's first go through the bull call spread. So purchase an October $50 call at $2.50 and simultaneously sell the October 55 call for $1. There is a net debit, or you're debiting your account $1.50 for the entire transaction. Does everybody understand that? That means that you are paying $2.50, but you're getting $1 rebate back, right? That's for the 55. Now the stock, if it goes up, you're going to make money up until above 50, but you'll stop making money at 55. And that's because you think the stock is going to go above 50, but you don't think it's going to go above 55. Okay? So you sell the higher strike price where you predict the stock to be, but slightly above at expiry. Okay? The max gain occurs if the stock closes above the higher strike price, then you'll make all the money from the lower strike price, and you're not going to lose anything. If it's just slightly above the 55, it's perfect for you. So the max loss on all debit spreads is the premium paid, which is a total of $2.50. Okay, the break even is the lower strike price plus the debit. So $50 plus the $2.50, and that's the total. The break even is $52.50. So if it goes above $52.50, that's where you're breaking even. Now, technically, there's a little bit more cushion in there because you collected that other dollar, but I'm not going to get into that at this point. I want you to be a little bit more conservative when you're doing your risk analysis. Okay, so the bull put spread, okay, short put is covered only when the writer also longs the put of the same class with an equal or greater strike price. So sell a put at the strike price that you believe the stock will not close under at expiration. Simultaneously buy a put with a lower strike price for insurance to limit the loss, and it's giving you a net credit. So example, sell ABC October 45 puts at $2.50 and buy the 40 put at $1. Okay, the max gain occurs if the stock closes above the higher strike price. Then you receive the credit, which is $1.50 in this case. The max loss is the difference between the strike prices and the premium received. So $5 minus $1.50, the most you can lose is $3.50. Now, what makes this worthwhile is that your batting average will probably be very high. So yes, you can see the risk-reward ratio is 350 in the worst case with a 150 gain. But if you have a very high batting average, then it makes sense. The break even is the higher strike price minus the credit, okay, and it's the same for selling naked puts. Now, certainly naked puts have a way higher risk situation because you can go all the way down to zero. And in this case, there's no cash outlay needed, only margin for the amount at risk. So you're not using any cash. That's why it's called a credit spread, because you're collecting money. But in this case, you're only using margin to make this trade. All right, so let's take a quick talk about straddles. A straddle is a long or short position in both a put and a call on the same security with the same exercise price at the same expiration date. Now, why would you do this? A straddle is ideal for earnings when you know that there's going to be a volatility event, but you don't know which way it's going to go. Sometimes when you do the calculation, you have to realize that the premium might be too much, that it might have to go too far in one direction. So in the case of a straddle, if it's flat and it doesn't really have a lot of volatility, then you might be a loser. However, if it does make a big move in one direction, the cost of the put needs to be deducted from the cost of the call. Let's say it goes up 20 points, but you paid $5 for the put and you paid $5 for the call. So effectively, you have to go up $10 for you to make money. And in this case, it would have worked out because it went up 20. So you're betting on both sides of the market simultaneously. And I hate using the word betting, but basically it's effectively what it's like. To try to take profit on a long straddle, the stock must move far enough to recover more than the total cost of both positions. A short straddle is the opposite bet. You're betting that it's going to stay within a range. And obviously, it has a lot of risk because if it does skyrocket up, you have in unlimited risk on the upside and a finite risk all the way down to zero on the downside. And that really has a huge margin requirement as far as options goes. Strangles are the identical except with different exercise prices. So strangle is the exact same thing as a straddle, but with different exercise prices. So you're changing the exercise price. You're creating a range, in the case of a strangle, as opposed to doing the same exercise price. Okay, so a long straddle is used in volatile markets when wide swings in either direction are expected. Purchase both a call and a put of the same stock. Best done if there's more time before expiration when premiums are underpriced. Break evens are the strike price plus total paid, and the strike price minus the debit. So maximum gain is unlimited. Maximum loss is the total premium paid. So if it goes way in your direction, you can make a lot of money, but of course you can lose whatever you paid for both of those positions that make up the long straddle. All right. Well, I hope you enjoyed this class on spreads and straddles and certainly found it educational and informative. I know it's just a starting tidbit. If you'd like to learn more about spreads, straddles, strangles, diagonals, calendar spreads, credit and debit spreads, I'd certainly like to work with you individually. DAS Trader is now offering mentoring opportunities. You can go to learningdaytrading.com. Scroll down to where it says individual trading, coaching, and mentoring. Click on DAS Mentor button and certainly choose me. If you'd like, there is a special going on where you can get a 30-minute Zoom session individually with me. For me to help you amp up your trading, work on a trading plan, and certainly teach you how to use your DAS trading software better. If you're not using DAS trading software, you should certainly get a demo of the DAS Trader Pro platform. And there's 2-week demos available, and you can also certainly subscribe to our award-winning simulator. Simulation software is phenomenal. If you've not used our simulation software, you should certainly check out and maybe participate in our number one best trader competition, which there's one coming up soon. There's always one coming up. Thank you so much for joining me. I look forward to seeing you in upcoming sessions, and certainly feel free to message me, like this, share this. Certainly click on the little bell if you'd like to get alerts for other educational seminars. Thank you so much for joining me, and I look to see you soon.